Welcome to StaalX Construction and Steel Podcast. Episode 15. Data points to strong years ahead for concrete construction. Why is the contractor confidence lacking? We'll be at World of Concrete 2026. Visit StaalX at booth N3368. See how we're simplifying steel sourcing for contractors, fabricators, and distributors. That's StaalX, booth N3368 at World of Concrete.
Welcome to the Deep Dive, where we strip away the noise from your source material and give you the absolute need-to-know insights. Today, we are plunging into the U.S. construction industry's outlook for 2026. And what we found is a market with a serious split personality.
That's a great way to put it. Our mission today is to really resolve this fascinating tension for you. Because on one hand, you have contractors who are feeling nervous, cautious.
Pulling back on hiring, even?
Exactly. But on the other hand, the foundational economic drivers, the actual structural demand, it points toward an absolutely massive boom that's starting to accelerate right in 2026.
And we're synthesizing three critical perspectives to do that. The latest AGC Contractor Sentiment Survey, a very bullish concrete market forecast, and a current skill market report. The goal here is to move past that general feeling of, gloom and really understand where the high-growth money is flowing and maybe what it's costing to get there.
Exactly. It's all about synthesis. So we're going to start with the mood on the ground, that near-term chill, before we peel back the curtain to see the immense forces that are already reshaping the industry.
Okay, let's unpack this and start with that immediate chill. To get a read on the industry's health, we're looking at the AGC Sage Construction Outlook Survey. It's nearly 1,000 contractors polled at the end of last year.
Right. 951 responses. And the overall sentiment is, well, it's clear. Optimism about 2026 is generally much lower compared to just 12 months ago.
And this pessimism isn't just a vague feeling, it's very targeted.
It is, and that's the key. We have to look at what they call the net reading. It's basically the percentage of contractors expecting more work minus the percentage expecting less.
So if it's negative, more people think the market's going to shrink than grow.
You got it. And when you look at those traditional commercial spaces, the numbers are deeply concerning. The most negative was private office space, hitting -14.
Wow. And right there with it was retail, right?
Even worse, retail was at a staggering -18. It shows contractors overwhelmingly expect those segments to slow down even more.
Which makes sense. That feels like a direct result of post-pandemic trends, hybrid work, e-commerce.
Absolutely. And you add high interest rates on top of that. And it's just very hard to finance those kinds of speculative projects right now.
We also saw some other traditional areas slip into the negative.
We did. K-12 schools were at -1, higher education at -5, and lodging at -7. So yeah, if your business is built on these traditional verticals, the outlook feels pretty cautious.
But I want to throw one number in here that just perfectly illustrates this split we're talking about.
Go for it.
While offices at -14, data centers were the single most optimistic segment in the entire survey. Their net reading was +57.
+57, it's a completely different world. It's the difference between legacy real estate and the future of industrial infrastructure.
And this caution isn't just about demand, it's also about the cost to operate, specifically labor.
Yes, this is where it gets really interesting on the operational side, because even while some sectors are shrinking, contractors are battling rising labor costs across the board.
So if you're bidding a job right now, you're automatically starting with a pretty substantial labor premium.
A huge one. And that cost pressure is persistent. Average hourly earnings for construction production workers rose 4.5% year over year.
Which is way above the overall private sector rate.
Significantly. The private sector as a whole was only up 3.8%. So that's a 0.7% difference. It adds up very fast. Construction wages are now almost 20% higher than the overall private average.
A 20% premium. That's a critical number in any project budget.
It is, and it lines up perfectly with what we're seeing in hiring. If you're paying that much for labor and you're worried about your pipeline, you're not going to be staffing up aggressively.
And the data shows that.
The data backs it up completely. Construction employment actually decreased by 11,000 in December. And even more telling, the hires rate for November was 4.1%.
Which sounds kind of low.
It tied the lowest November rate in the entire 25-year history of the data series. Contractors are holding on to the people they have, but they are very reluctant to expand.
So, high labor costs, sinking sentiment in offices and retail. Where's the money actually going? Where's this big boom you mentioned hiding?
That is the critical question, because despite all these headwinds, the data suggests the industry is nearing the bottom of its current cycle. A powerful rebound is set to accelerate in 2026.
And this is where that Ducker-Carlisle forecast comes in, which paints a very different picture.
A very bullish one. They're projecting total put-in-place construction will rise 5.3% in 2026 and then grow at an average rate of 5.7% every year through 2029.
That is incredibly strong growth. It's way more optimistic than, say, the 1 to 3% numbers from the AIA or NEHB.
The difference is where that growth is concentrated. It's pouring into these concrete-intensive, highly specialized segments. We already mentioned data centers at plus 57. Power projects were second at plus 34.
So not office buildings. We're talking industrial infrastructure engines.
Exactly. And the concrete market outlook shows us why those engines are so demanding. The momentum in data center construction is just relentless. It's driven by AI, cloud storage, video streaming.
So let's break that down. What does high-spec work actually mean for, a concrete contractor? Why does an AI data center need so much more than a regular warehouse?
It's all about physics and redundancy. These facilities have incredibly heavy machinery server racks, massive backup generators, huge cooling systems, so they need deep poured foundations that can handle that concentrated weight.
And I'm guessing they have to be incredibly stable.
Unbelievably stable. They often require advanced seismic reinforcement, even in low-risk zones, because uptime is everything. We're also talking high-specification tilt-up wall systems for security and for precise climate control. This is not simple work.
It sounds like it rewards specialization, not just volume.
Absolutely. It demands firms that can execute at scale and manage complex concrete mixes. The estimates show this sector alone is set to surpass $50 billion by 2029. That's where the high-margin work is.
And beyond the tech boom, the sources point to a manufacturing renaissance as another key driver.
That's right. You have industrial policy, trade shifts, incentives. All of it is driving this reshoring of critical supply chains. That means new manufacturing plants and modernizing old facilities.
Which, like data centers, means heavy foundations for machinery.
Exactly. Heavy foundations, high durability flooring. It's all structural demand that provides a solid long-term base for the industry, insulating it from the volatility in those traditional commercial sectors.
We should also touch on the residential side. It's not the main engine, but it's stabilizing.
It is. The housing market is getting ready for some measured growth thanks to the expectation of future Fed rate cuts. But what's critical is where that growth is. It's highly concentrated in the South.
Right, in places like Texas, Georgia, the Carolinas.
The majority of new housing is happening where slab foundations are the standard. So for contractors in those regions, it means a healthy rising demand for foundations and flat work. The South could account for almost half of all construction spending by 2029.
Okay, so this paints a really clear picture. Long-term demand is robust, but it's focused on these concrete and steel-intensive mega projects.
And if those projects are booming, you'd expect to see that show up immediately in the cost and supply of building materials.
Which brings us directly to the steel market.
This is where those macro forces hit the budget sheet. The steel market is confirming this high demand trajectory. We're seeing aggressive, rapid price increases being announced by producers right now.
How aggressive are we talking?
Well, a producer like Nucor just announced a $60 per ton increase for beams, which are essential for structural framing.
$60 a ton is a big move.
It's a very aggressive signal of demand confidence. They also announced a $30 per short ton increase for rebar, which, is the skeleton for all those concrete facilities we were just talking about.
And rebar supplies are already tight.
They are. The supply chain is feeling the squeeze. Inventories of common 20-foot lengths are short, and lead times are already stretched out well over a month. For a contractor, that's a nightmare for scheduling.
And what's supporting these price hikes?
The scrap market. There's an anticipated rise in January scrap prices, somewhere between $20 and $40 a ton, and that's expected to keep the pricing momentum going through the whole first quarter. It's input cost inflation in action.
This high domestic pricing creates a kind of paradox with imports, doesn't it? The U.S. has this huge 50% tariff on a lot of steel, but imports are somehow becoming competitive again.
That's the key insight. The domestic price has gotten so high that it has managed to basically swallow that enormous tariff. For many products, international bookings are now competitive again.
So our own high prices are acting like a magnet, pulling in supply from overseas just to meet the demand.
Exactly. We're expecting a wave of new bookings from the import market because domestic supply is just so expensive and has such long lead times. It's the clearest material confirmation you can get of the economic strength in these new upcycle segments. The money is flowing, and it's inflating the entire supply chain. So, to summarize this deep dive, the construction landscape in 2026 is really defined by this deep split. You've got the short-term challenges, high labor costs, falling expectations in old sectors like office and retail, but at the same time, the long-term structural demand from data centers, from power generation, from the manufacturing renaissance is incredibly robust. And these segments are already pulling so hard on the supply chain that we're seeing these sharp, aggressive cost increases in materials like steel.
So what does this all mean for you? The core challenge for contractors isn't really finding work. It's managing the input costs and pivoting the business. It means you have to aggressively focus your efforts on those specific, high-specification projects like data centers that offer the most growth, even if that means dealing with long lead times and high-premium labor.
And that leads us to a final provocative question. Given this expected acceleration of consolidation in the industry and the rising demand for huge, complex work like data center campuses, how will the smaller regional contractors adapt? How will they handle the rising costs and the growing need for scale and specialized execution to effectively compete with the industry giants who can absorb all this volatility? That's something for you to consider as these changes speed up.
That is an excellent point. Thank you for joining us for the deep dive. We hope this has given you the essential insights you need to understand construction's split personality.
Thank you for listening. Explore more at www.staalx.com.